Welcome back to The Deep Dive, the show where we really try to cut through the noise and give you those crucial insights you need. Today, we're diving deep into the world of global logistics, specifically looking at a real giant, FedEx Corporation, ticker FDX. Our mission here is to give you a clear picture, unpack what's happening beneath the surface, their financials, strategy, where they stand competitively.
Exactly. And we're drawing from a pretty comprehensive report covering all that recent financials, their big strategic moves, market positioning. Think of it as, your shortcut to understanding the real story behind this key player in the global economy. Not just the numbers, but what they actually mean.
Absolutely. And just to set the scene quickly, as of June 25th, 2025, FDX is trading around, $229.51. Our sources are suggesting an estimated fair value that's a bit higher, closer to $249.39, and maybe an internal target around $251.88. So, right off the bat, there's this hint of potential upside we should keep in mind. Okay, so let's unpack that recent performance. Q4 fiscal year 2025. The market's been, well, challenging, hasn't it? What do those Q4 numbers tell us about FedEx's, operational health?
Well, what really jumps out from the report, despite that tough environment you mentioned, is that FedEx actually managed a 1% year-over-year revenue increase. Now, 1%, okay, maybe that sounds small for a company this size.
Right, just 1%.
But it's how they did it, the efficiency behind it. That's what signals, strong performance.
That's exactly what caught my eye, too. Because that seemingly small 1% growth, it turned into something much bigger on the bottom line, didn't it? An impressive 8% growth in adjusted operating income. And maybe even more telling, that 60 basis point expansion in adjusted operating margin, that's what, 0.6% more profit from every dollar of revenue?
Yeah.
That's quite a gain. When we talk about operational leverage, what does that actually look like for FedEx?
That's a great way to put it. Operational leverage here basically means even that small revenue bump leads to a much bigger profit jump because their fixed costs get spread out more. And FedEx really achieved this by being incredibly disciplined on spending. The report highlights a huge achievement. They nailed their $2.2 billion drive cost-cutting goal for FY25.
Ah, the Drive initiative.
Yeah, that was their big structural cost reduction plan. And hitting that target actually meant they met their really ambitious two-year goal of $4 billion in savings starting from FY23. Pulling that off, especially with all the external pressures, that clearly made a massive difference to their profitability. It's why 1% revenue could become 8% operating income.
So, serious cost discipline paying off. Looking ahead then, Q1 fiscal 26, what's the near-term picture? The report suggests consolidated revenue flat to maybe up 2% year over year, adjusted EPS somewhere between $3.40 and $4. What's shaping that forecast?
Right. So that outlook, it does factor in some pretty significant headwinds. The report points to about a $170 million hit to adjusted operating income. That's coming from slower international exports, particularly affected by, global trade policy shifts, especially on the Trans-Pacific route.
Okay, trade policy impacts.
And on top of that, there's another $120 million headwind from the U.S. Postal Service contract expiring. Now, it's important to note these are mainly expected to hit in the first 4 months of FY26, so some near-term pressure, definitely.
But it sounds like management isn't just sitting back, right? They're actively trying to counter these headwinds. The report says they expect to get about $200 million in new transformation benefits just in Q1 FY26. And that feeds into a bigger goal for the whole fiscal year, doesn't it? Something like $1 billion in savings from both the ongoing Drive stuff and their newer Network 2.0 initiatives. It's like they're simultaneously, trimming costs and building a stronger, more efficient operation. Speaking of building stronger, let's shift gears a bit. From the immediate financials to the longer-term strategic vision. What are the big bets FedEx is making for future growth and efficiency?
Well, a central piece is definitely the Network 2.0 program. The report says it's progressing well. The goal here is another $2 billion in savings by the end of FY27. It's really about optimizing their physical network, integrating their different units like Express and Ground much more tightly.
$2 billion more. That's significant.
It is. But the report also adds a note of caution or maybe realism. The big financial impact, the actual savings hitting the bottom line, isn't really expected until later in FY27. There are, pretty significant upfront costs to implement these changes. So it's a longer play, but with a potentially huge payout.
And it's not just internal tweaking, is it? There's also the huge news about spinning off FedEx Freight, expended by June 2026. That feels like a massive strategic shift, creating two separate, focused, publicly traded companies. They've even announced the leadership for the independent freight company already. John A. Smith as CEO, R. Brad Martin as chairman. How does separating freight fit the bigger picture?
Yeah, that's a really big move. It directly ties into their stated commitment to improving return on invested capital, ROIC, and ultimately boosting shareholder returns. The thinking is, by splitting them up, each company can focus better on its specific market, manage its capital more effectively, and maybe get valued more appropriately by investors. It's a strategic unbundling, really, trying to unlock value that might be hidden within the larger structure.
It sounds like they're making a real effort to communicate this vision clearly, too. The report mentioned Investor Days coming up early in calendar 2026 for the main company, and then a separate one for FedEx Freight next spring before the spinoff happens.
Right, getting everyone on the same page about the long-term roadmap, transparency for investors.
Okay, let's talk about resilience. In such a tough market, what gives FedEx its competitive edge, its economic moat, as they say? And how are they dealing with these market challenges right now?
FedEx definitely has what analysts call a wide economic moat, and it primarily comes down to its just unparalleled global network. I mean, think about it. This network connects 99% of global commerce, reaching over 220 countries and territories.
That scale is just incredible.
It really is. And replicating that infrastructure, the planes, the trucks, the hubs, the last mile delivery capabilities, it's not just about money, though it would take staggering amounts of capital. It's also about decades of operational know-how, navigating regulations worldwide. It represents a truly immense barrier to entry. It makes it incredibly hard for anyone else to challenge their global reach effectively.
So it's not just big, it's flexible too. You mentioned that scale allows for adaptation. We've seen them adjust capacity like on the Asia to America's route.
Hmm.
And that tricolor strategy, they talk about enhancing flexibility, balancing service levels, cutting costs. It seems built for adaptation.
Exactly. But even with that strong moat, they are facing headwinds. The report is clear about that. There's ongoing weakness in the industrial economy, particularly impacting B2B volumes. That hits FedEx Freight, and also those high-margin B2B shipments at FedEx Express.
Right, the B2B slowdown.
And then there's the volatility in global trade policies we touched on earlier. That adds uncertainty and has those direct financial consequences, like that $170 million international export headwind. These aren't small issues, they're significant pressures.
So how are they tackling these challenges head on? Identifying them is one thing, but what's the action plan?
Well, the company seems to be actively managing these risks by really doubling down on that operational leverage and cost control we discussed. They sound confident that because they're leaner now, they're well positioned for strong profit growth that flow through when the industrial economy eventually picks up.
So prime for a recovery.
Right. And they're actively using the flexibility of their network to match capacity with where demand actually is, scaling up or down. What's also interesting is how they're leaning more into data and digital tools, not just for internal efficiency, but to help their customers deal with the complexities of global trade rules. They're basically trying to make complex international shipping less painful for their clients.
Okay, let's pivot to financial discipline. Capital allocation, shareholder returns. What's the story there according to the report?
Yeah, this connects back to that disciplined approach. FY25 showed really strong financial discipline. They significantly cut their capital intensity, that's CapEx, relative to revenue. Total CapEx was $4.1 billion. That's actually the lowest it's been in over 10 years.
Wow, over 10 years.
And as a percentage of revenue, it was 4.6%, and that's the lowest level since way back in fiscal year 98. That's a pretty fundamental shift in how they're managing spending.
And for FY26, the plan is about $4.5 billion in CapEx, so a slight increase. But the type of spending is key here, isn't it? The report says around 85% of the FY25 CapEx went into modernization and optimization, not just adding more capacity. What does that tell you strategically?
It screams a clear strategic focus. They're not just blindly expanding. They're investing in making the existing network smarter, more efficient. Think technology, automation, upgrades. It's about improving that return on invested capital, the ROIC, getting more bang for their buck from the assets they already have. That's absolutely central to their long-term value plan.
And beyond investing back into the business, what about directly returning cash to shareholders?
The commitment there looks pretty robust, too. The report highlights $4.3 billion returned in FY25. That was through a mix of stock buybacks and dividends. It signals confidence from management in their cash generation and a real dedication to shareholder value.
And we just saw more evidence of that recently, right? A 5% hike in the annual dividend announced for FY26. That brings it to $5.80 per share annually, or $1.45 per share each quarter. That's a tangible return for investors.
Exactly. Real cash back to shareholders.
Okay, so let's try to wrap this up. What are the key takeaways for you, the listener, trying to make sense of FedEx?
We've seen strong operational results, really driven by significant cost cutting, a clear strategic vision unfolding with Network 2.0 and the freight spinoff. There's that undeniable competitive moat from their massive global network. And now this very disciplined financial management focused on shareholder value. Yeah, I think connecting all those pieces, despite the market uncertainty and those near-term headwinds we talked about, FedEx really seems to be taking proactive steps. Their focus on cost control, optimizing the network strategically, and these moves to unlock value like the spinoff, they position the company pretty well, I think. They're not just weathering the storm, they seem to be actively reshaping themselves to create long-term value. It's genuinely fascinating watching a logistics titan like this evolve its global strategy in real time. It makes you wonder, with this intense focus on efficiency and leverage, how might their push for smarter, not just bigger, actually ripple out and influence the whole global supply chain landscape in the years ahead?
That's a great thought to end on. Absolutely fascinating indeed. If you found this deep dive valuable and you want more insights like this coming straight to you, please make sure to subscribe and definitely hit that bell icon. It really helps support the channel.